Hey guys, I got 4 fresh trading opportunities that I want to walk you through today, each showcasing a different style of technical analysis. So no matter how you trade, there's a little bit of something here for everyone. And of course, if you're new to the channel, we're going to do this in a very beginner-friendly way. I am also going to answer the question that seemingly everyone in the market has been asking for the past few days. What the hell happened with the yen? And no, it wasn't intervention. Yet. Anyway, I'll save that to the very end because I know many of you guys are here just to see the charts. You don't really care about the fundamental stuff. But I would say this, having an understanding about what happened is not just interesting, but it could be very helpful for your trading as well, whether you're looking at it as a chance to gain some bigger opportunities in the market or a chance to manage your risk. All right? Let's hop in. So let's start here on the Aussie Canada. And what we're looking at is a structure-based channel trade. This is actually something I wanted to bring you a couple weeks ago, and I cut it out to save time, and it ended up working exactly how we thought it would. But as you can see, price action has been ranging back and forth between this sideways channel. You can see we have 3 levels of resistance on the top. 1, 2, 3, and we've also put in our 3rd level of resistance on our support on the bottom, 1, 2, 3. And the expectation is, well, just as we've done before, work our way up back to the top of this channel. So we're looking for a buying opportunity here. Now, when we go down to the 4-hour, I'll first show you what we were looking for, a couple weeks ago on the original downside of this channel. So at the time, price action had bounced from swing high to swing low to swing high to swing low, and we were working our way right up here. And we put together this nice classic reversal pattern called a rising channel. You can see the momentum has slowed. That means the slope of the grade has decreased. You can see from the bottom here to the top here, it goes up at a pretty rapid pace, and then we start getting into this choppy action. What's expected is a loss of momentum, and well, we came all the way back down. As we came back down, we put in another classic pattern formation. It's maybe not your best example of one, but it's a head and shoulders type of pattern. And what happened here is you can see that price action dove down. We had a little bit of a retracement. We came down here. We actually triple bottomed, right? So it's like a 3-headed head and shoulders, right? We came back up to retest the previous retracement. We then failed to extend lower, right? Holding the support once again. And then the most important thing is right here. We have traded back above what's called the neckline, which is this previous level of structure right here. And that's what gives us confirmation of that classic pattern. It's also what allows us to make the prediction that price is likely to go higher. Now, something that happened today, right, is we actually put in a nice inside bar. And I'm going to show you this real quick. You can see there's a few things about this bar that are very intriguing to me. One, it is an inside bar, which means it completes, completely within the range of this previous bar, which is called the mother bar. That's typically a sign of consolidation, and we would expect a breakout, right? Contraction leads to expansion in the market. But if you understand how to read a candlestick, this is also a very positive bar as well. If we were in a different location, we would look at it as a pin bar. We're going to call this a strong bullish bar because you can see that there's a wick to the downside, which means at some point price tried to push to the downside and it got rejected and beat back up. And the close is almost at the extreme of the candle. So the bulls were able to close at the very high. Now, we didn't really get much today on this final candle, but it is a US holiday, so we didn't get much movement in the market as well, or at all, I should say. But this is a very positive candle. So how can we look for a move to the upside? Well, 2 main ways that we'll probably want to focus on. One would be an aggressive breakout trade, right? You can see the high is right here. If price action can break the high of this candle, if you are aggressive, you can use a buy stop to get involved right away. So as that train starts moving, choo choo, right? You go up to the upside, or you can do my preferred way, which is a pullback, meaning look for price action either from right here to pull back in the structure before expanding up, or if we were to break higher, right? Break higher. Let me just steal an arrow right here. Break higher, then pullback, and then continue up. So fact of the matter is we're looking for a move all the way back up to retest these highs, moving across the channel, making this a very nice opportunity on the Aussie Canada. Next, we're heading over to the DAX. And if you're asking Akil, what are we doing on an index? Well, a chart is a chart. Technical analysis is technical analysis. The cool thing about this skill is it can be used on any time frame, on any asset class. So you can be dangerous in any market or every market. And the DAX had a nice day to end the week. Let me just go back down to a daily chart right here. And you can see that we ended with new highs, right? Here is our previous high. This is a inverted head and shoulders. So the head and shoulders pattern I just showed you, this is a upside down one, right? Which is a sign for continuation, which we got. But we are now putting in new highs. And the question is, what's next? Well, as a trend continuation trader, you should be looking for a move to the upside. As a counter trend trader, you should be looking for a move to the downside. What if I told you that the exact same analysis could be helpful for both? So let's start with the counter trend side. What we have forming here, if we zoom in a little bit, is going to be called a bearish butterfly pattern. A butterfly pattern is a harmonic pattern, is a Fibonacci-based pattern. One of my favorite patterns to explain, because essentially what we're waiting for is for the market to break out, and then we're looking for a place of exhaustion. So just like the Aussie Canada, how we had that rising channel, which was a loss of momentum pattern that came diving back down, the butterfly pattern is going to be the same thing. And I won't throw the whole thing on for you and waste time because I want to keep this thing moving. I got World Cup matches to watch. But what we're looking for is a move up to this 127 Fibonacci inversion. So this pattern looks something like this. We have our initial swing high to swing low being our X to A. Our deep retracement right here being our B to C, or excuse me, A to B. This next retracement being our B to C. And if price action comes to this 127, that is going to be our D completion. Now, I know what you're asking yourself. Akil, we just put in all-time highs. Why would I want to get short? Wouldn't the path of least resistance be getting long? And yes, it would. So, where a counter trend trader will be looking to take shorts at this area right here in hopes of making some profit on the way down, a trend continuation trader, well, they don't want to buy at the highs. That's not a very cheap place to buy. Would you go to the store and buy something when it just got off of sale and it's much more expensive? No, you would wait for it to go on sale again. And that's exactly what we're doing here. As a bullish trader, I would wait for a cheaper price. So the question that I'm asking myself is this. Price has just broken previous all-time highs. We're at the highest price we've ever been. When is the market going to take a breather and give me an opportunity to get back involved at a cheaper price? And this is it. So that same butterfly pattern where we would expect a potential move downward, if this occurs, this is going to be the retracement that you can wait for your next opportunity to trade it up. Boom! Next up is gold, and gold has been taking a little bit of a hit recently, but with our failure of a non-farms report coming out this Thursday, gold ended the week with a little bit of momentum, clearing these inside highs right here. If we head down to the 4-hour on gold here, you're going to see that we did end the week with a little bit of consolidation. And if we go one more time frame down, you can see this consolidation starts to look like something else. And this is going to be another classic pattern formation. We have our swing low to swing high right here, representing our flag pole, and this little tight area of consolidation, which is slowly retracing as well. This is going to be our flag. So gold is putting in a bullish flag pattern. This is a classic pattern formation where you would expect a move higher, but I have a warning for you, and it's going to be up to you how you want to trade this. But for me, I always value the where, which means the location of price, more than the what, which is the actual formation. So although the flag formation, a bullish flag, is a really good trading signal, for me, we're not at a place where I would value it. And if we hop back up to the 4-hour chart, right, let's go through our IPDE process: identify, predict, decide, execute. Hey, Akil, identify. Where is price trading at? Well, let's see. Price did swing high to swing low and back up and back here. And let me just see if I draw a line out. Price is trading at, oh no, a previous level of structure. Well, did we violate that structure or did we hold that structure? Well, we held. Now, my trading rules state that in order to make a bullish prediction, we have to violate a previous level of structure. So we have to break and close above this level of structure in order for me to have a bullish bias. So because we did not do that, I am not interested in buying opportunities until we do that. Now, that's just me. A flag, as we mentioned before, is a breakout pattern. And if we are going to break out of a previous level of structure, we would need something to cause that breakout. So looking at this from the other perspective, perhaps this flag pattern is the thing, let me just draw it back on, that eventually causes the breakout of this level. So you may be asking yourself, if you're new, Akil, which is the right answer, which is the wrong answer? And that's the fun part about trading. There is no right, there is no wrong. It's all about different perspectives. The only right answer is the one that you have in your trading plan. So because my rules say I can't be involved in this, then I'm right by not being involved. If your rules say you should be involved in that, well, you're right by being involved. And how we determine that is by back testing, right? Going through historical data, crunching the numbers on the thing that we're trading, and ensuring and giving us proof that it does indeed have an edge versus just coming into the market and guessing. Because I know that many of you guys do just that. You come into the market, you guess, there's no consistency in your action, and therefore there's no consistency in your results. All right, so now that we got the technical stuff out of the way, let's talk a little bit about this yen. If you look very closely, I'm not sure if you guys can see it, but there looks to be a big red candle on your screen. And I know many of you guys are looking at this and saying, big red candle, oh my gosh, I've seen this before. Look at this, another big red candle. And this ended up being the intervention. Has the intervention started again? And my answer is no, but yes, kinda. It's in a different way. So this wasn't actually Japanese intervention. It just doesn't make any sense, right? This happened Thursday morning, New York time. We had a very important jobs number coming out on Thursday morning. It wouldn't necessarily make sense to have intervention right before that jobs number coming out, right? It wouldn't make sense. You would do it the next day on a holiday. You do it today on July 3rd, right? So it wasn't that. But what I think it was the reaction to Japan doing more of its verbal intervention, right? We've discussed this in the past here, where the first form of intervention is just talking about it and scaring people and saying, yeah, we're going to do it, we're going to do it, we're going to do it, and letting the market act for itself. And that's exactly what happened here. You see, Japan came out and announced that, hey, we're going to do an ambush style or a stealth style of intervention. And what that means is this. There are traditional styles, I'm not even sure the name of it, but where they would come out, right? The Ministry of Finance would say, hey, we're not letting the yen go past 162, right? They give a line in the sand number so us traders know, hey, right, if it gets to 162, let's not mess with it. This is very similar to the massive crash on the Euro Swiss that we saw many, many years ago, where they protected a level, I think it was 120, and then pulled the rug out, and then biggest crash in Forex history. So instead of doing that, what the Ministry of Finance came out and said was, we're going to take this stealthy style. And pretty much it reminds me of like my kids. They're saying, we're going to intervene, but we're not going to tell you where we're going to intervene. And in a way, that is a lot more scarier than drawing a line in the sand. You see, a line in the sand tells me that this is where they're interested in. Them saying, I'm not going to tell you, brings a lot of fear to the market, because that magic number used to be 160. Then it used to be 161. Then it was 162. And well, if you're someone that has a long position on the dollar yen, and you remember what happened back here where we had this big old collapse, you probably don't want to be a part of that. So a combination of fear, and then we saw the bad number come out later, is what drove this move. Now, the question is, how do we handle this? And originally, from a technical perspective, I actually had a buying opportunity on my radar, right? Pound yen is a very similar situation, but if we break these levels right here, right, we saw nice rejection to the downside, little neutrality right here, but then we saw a nice rejection candle to the downside to end the week. If we were to break this level, I do think we can push back up to here. But after hearing about the potential ambush intervention, the question you want to ask yourself, and the question that I ask myself is, Akil, is it worth the risk? And every Monday we do a private Q&A session with our tier one trading clients. And this Monday we broke down 2 trading plans. So we reviewed them and kind of fixed them up for our traders. And what was interesting was that in both of those trading plans, our traders had a handful of news events that they listed where they said, hey, do not trade during this. Do not trade during that. Do not trade an hour after this. And I would say that intervention, at least kind of rumors of it, is certainly something worth adding to that list. It would not be very smart to be long the dollar yen when you know that the risk is heavily tilted towards another potential intervention coming, which would give us a big short move here on the dollar yen. On the other hand, you can also use it to your advantage, because if you can find a legit bearish opportunity, and when I say legit, I mean you're not making one up just to be in it, but let's say price comes to a previous level of structure where we hold at this level, right? We kind of bounce back and forth. We retest these highs. We do a double top, something like that, which is a legit trade that you would be in anyway. Then this is an opportunity where you can go for that home run trade where you're trading this as you normally would, right? But if you're let's say a 2-position trader, instead of taking your full position off at a retest of the lows, maybe you're only taking half off and then you're leaving half on in case that potential intervention comes when Japan tries to squeeze traders out of the market. Same thing if we were to go higher, and I think we have a much better likelihood of that happening at a higher level, but we'll continue our analysis of this as it goes on. I do think we're more likely to see it up here or near 62s than right here. But the point is, if you can establish yourself in the position which favors the underlying news that's coming out, you can put yourself in a position to catch some really, really, really big moves in the market. And honestly, if you can do that once or twice a year, man, your trading account is going to love you. Speaking of love, you're going to love this technique that you can use to evaluate your trading and find out a solution for those problems that keep reoccurring time and time again in the market. And you'll also love the fact that we have extended the recordings for the Freedom Trader Workshop. It was available until last week, but due to popular demand and threats, we're going to leave it open until Sunday. So if you missed the workshop, link is in the description box below. Recordings are up until Sunday, so watch it right now. Hurry, hurry, hurry. And until next time, plan your trade, trade your plan. Take care.